You wake up on a Friday morning, your paycheck finally arrives. For a brief moment, you feel richer. Then your phone begins buzzing. A credit card payment, a car loan, a mortgage reminder, a buy now, pay later installment. Within hours, most of that money is already promised to someone else. Strange, isn't it? You worked all month, yet the money barely belonged to you. Now imagine something even stranger. The bank that lent you the money doesn't actually want you to pay everything back immediately. That sounds backwards. Wouldn't a bank want every customer to become debt-free as fast as possible? Not exactly, because the most valuable customer isn't the one who owes nothing. It's the one who keeps borrowing. For thousands of years, debt has shaped civilizations. Ancient farmers borrowed grain. Kings borrowed gold to fight wars. Merchants borrowed silver to cross oceans. Today, the numbers are almost impossible to imagine. American household debt has climbed above $18 trillion. That includes mortgages, student loans, auto loans, credit cards, personal loans. Every month, billions of dollars flow through the banking system. Most people think banks simply store money. That's only part of the story. Banks are really businesses, and like every business, they need revenue. So where does that revenue come from? The answer is surprisingly simple. Time. More specifically, your future time. When a bank lends you $10,000, it isn't only selling money, it's selling time. Time you don't have to wait before buying something. A car today, a house today, a vacation today. The bank gives you the future, then charges rent on it. That rent has a name: interest. Even a small interest rate changes everything. Suppose you borrow $10,000. A 5% interest rate means you'll pay back more than you borrow. Stretch that loan over years. The bank earns thousands without creating another product. No factory, no warehouse, no shipping.
Just numbers moving across screens. Economists call this financial intermediation. The bank collects deposits, then earns the difference between what it pays savers and what borrowers pay back. It sounds almost effortless, but there's something deeper happening. Why do so many people willingly sign up for decades of payments? The answer isn't greed. It's psychology. In 1979, psychologists Daniel Kahneman and Amos Tversky showed that humans don't always make perfectly rational financial decisions. We value immediate rewards far more than future costs. A brand new car feels real.
Monthly payments feel distant. A bigger house feels exciting. 30 years of interest feels invisible. Banks understand this tendency.
Not because they're evil, because they study human behavior. Every loan is built around one simple truth. People naturally focus on what they gain today and underestimate what they sacrifice tomorrow. The result is a system that quietly encourages borrowing long before the bill arrives. But here's the real question. What happens when borrowing stops becoming a tool, starts becoming a lifestyle?
The average American doesn't wake up planning to become trapped by debt. It happens one decision at a time. A credit card for emergencies, a car loan for convenience, a mortgage for stability, a student loan for opportunity. None of these choices seem unreasonable. In fact, many are necessary. Debt itself isn't the villain. The problem begins when debt starts buying things that disappear faster than the payments. A vacation lasts a week. The loan can last years. A new phone feels exciting for months. The monthly bill can outlive the excitement. This is where interest quietly changes the story. Imagine rolling a snowball down a hill. Debt often behaves the same way. If payments are delayed, then new interest is charged on that larger balance. Suddenly, you're paying interest on yesterday's interest. This is called compound interest. When you're investing, compound interest can become your greatest ally. When you're borrowing, it can become your greatest enemy. Isn't it strange that the same mathematical formula can either make you wealthy or slowly drain your paycheck? Banks understand this better than almost anyone. They don't expect every borrower to miss payments. In fact, they prefer something much more predictable. Customers who pay consistently, month after month, year after year. Reliable borrowers are incredibly valuable. That's why banks compete so aggressively for them. Reward points, cashback, travel miles, sign-up bonuses, low introductory rates. These offers aren't acts of generosity. They're marketing investments. The goal is simple: encourage you to borrow more often. Research in behavioral economics has shown that people spend differently depending on how they pay. Studies by Drazen, Prelec, and Duncan Simester found that consumers are often willing to spend significantly more when using credit instead of cash. The pain of paying becomes delayed. Your brain notices the purchase. It barely notices the future payment. That tiny psychological gap changes everything. The card feels effortless. The bill arrives weeks later. By then, the emotional reward has already faded. But the financial obligation remains. This doesn't mean credit cards are always bad. Many people use them responsibly. Pay the balance every month, earn rewards, build credit. Never pay interest. Ironically, those customers are usually less profitable than people who carry balances. Because interest, not the swipe itself, is often where much of the revenue comes from. The system isn't designed around a single purchase. It's designed around thousands of tiny decisions. One swipe rarely changes your life. 10,000 swipes just might. And that leads to an uncomfortable question. If debt feels normal, how much of that feeling was carefully designed?